monetary policy.
Good afternoon, everyone. My name is David Zervos. I'm the Chief Market Strategist at Jefferies, and it's my pleasure to welcome you to our panel this afternoon on monetary policy. It's, I'm sure, a subject that's very close on everyone's mind, and if you've been attending some of the earlier panels today, I was certainly surprised at how many times I heard the word taper and QE and balance sheet at central bank in the context of credit panels and European stress and the like. I think, as everybody's probably well aware, over the last 5 years, the operation of central banks within the marketplace has become about as big as it ever has in the history of our trading careers. And I guess it's a testament to the Milken Institute that we keep having, for the last 3 or 4 years, monetary policy panels at a conference that is generally focused a little bit more on the private sector and entrepreneurship and the like. With me is a very distinguished panel. I'll start at the end. Laurence Boone is at Bank of America. She's the chief European economist and will certainly give us some great perspective on the ECB. Next to her is Jason Cummins. He's the head of research and the chief U.S. economist at Brevan Howard. Next to me on my left is Spencer Dale. He's the chief economist at the Bank of England and actually a voting member on the MPC. And finally, at the end, we have Brian Sack. He's the co-director of research at D.E. Shaw and the ex-system open market account manager for the New York Fed, one of the guys who bought a lot of bonds. So with that, I'm going to open it up, and the format will be to throw out a question to one of the participants and then have them tackle that, and then allow some of the other participants to move on, and then we'll move on to additional questions as time permits. And the first question I had really gets to the heart of what central banks are doing today. As I think we heard earlier, the Fed's balance sheet started on the day of Lehman Brothers at $800 billion and is now $3.7 trillion. If you add up total balance sheet increases across the major central banks, you come up with a number over the last 5, 6 years of about $10 trillion worth of QSIPs that have been taken out of the private sector and put onto the public sector balance sheets. So I wanted to start with you, Spencer. What are the limits to central bank balance sheet expansion? And is there a percentage of GDP, balance sheet percentage of GDP, such as a debt to GDP limit in the Reinhardt and Rogoff analysis, that brings on financial instability? Or can we just keep on going as long as the medicine is needed?
So I don't think there's any special magic number which says you can't go beyond that point. I think the natural limit to QE is sort of a democratic legitimacy, a credibility argument. If this instrument, if buying 20 or 25% of nominal GDP of assets is not solving the problem, it may start to question whether that's the right instrument. And I think it's that sort of question about the legitimacy of the instrument, which I think is likely to bind first rather than any particular magic number. I guess in terms of financial stability, I can certainly understand the risk associated with buying up safe assets and encouraging investment houses to get into risky assets. But there's also a counterfactual issue here. If you do less quantitative easing, presumably you've got to do some other type of policy loosening. If the counterpart to doing less quantitative easing is to keep interest rates lower for longer, I think it's a moot point that has less financial stability risk than doing more QE.
Brian, do you have some thoughts on that? I know you and I have discussed this at length many times, but limits to monetary policy with the balance sheet, do you see any?
I agree with Spencer that, I mean, there's no hard limit, no magic percent of GDP that sends up warning flags. I think for the Federal Reserve, they've explained it's a cost-benefit calculus, and I think there's a few things that, informally put a limit on how far the Fed will go. One is the benefits are uncertain. So I do think the benefits of QE have been substantial, and I think most policymakers share that view. But there is some degree of uncertainty about those benefits relative to the more traditional policy instrument, and I think that leads naturally to temper the use of the instrument to some degree. And the other side is the cost. This instrument does have some costs. The FOMC has talked about those costs. Those costs have to do with market function, exit complications, the fact that the balance sheet could have fiscal implications through P&L, and financial stability issues, as you mentioned. So these things together, the uncertainty of the benefits and the fact that there are some costs, just place a natural limit on how far the central bank will go. But as we've seen in the case of the Fed and other central banks, they're willing to go pretty far. And I think what we see now is, this discussion about tapering, even though it was tabled at the last meeting, I think we're coming to a point where, the Fed will start to reduce its purchases. And I think that's kind of a reflection that they've gotten to what they see as a pretty optimal point in terms of that cost-benefit trade-off.
Jason, I was going to ask you, with all of the psychological prepping that we had in the last 4 or 5 months and the seeming, I don't want to say anti-QE sentiment, but certainly the idea that QE was not as effective. We saw some San Francisco Fed papers released, and the market was very convinced that QE was becoming a less important tool, and we were moving maybe to a world more of forward guidance as a tool. How do you see that trade-off on the balance sheet, the cost benefit, and also we'll start to open it up maybe, and I want to get Spencer's view on this too, of the trade-off between using forward guidance and using the balance sheet for monetary policy accommodation?
So let me, in order to answer your question, take a bit of a step back to first principles and try and explain what I think is going on in terms of first principles in order to try and present a way to contextualize the last 6 months, which have kind of prepped the market for one thing and then the Fed kind of steered in another direction. If you go back to what central banks should be doing in this environment, central banks should be credibly promising to keep interest rates low for a long time to achieve a goal that everyone can understand. And I think the issue in terms of the messaging, and this is true not only with the Fed but with other central banks as well, is that they've had a bit of difficulty trying to figure out how to credibly enforce that promise to keep interest rates low, and then also just what kind of goal they're going after. We have Spencer here who can speak authoritatively to the reaction function of the Bank of England, but my interpretation of what the Fed is trying to do is they're not actually quite sure what their goal is. Are they just trying to get back to full employment? Are they trying to target a higher level of activity for a period of time so that you do some catch up? My interpretation of what they did in September is some combination of a switch in the reaction function and a little bit of discomfort just with financial market conditions. In particular, what they saw was interest rates went up, and they feel that they have a bunch of different tools to try and keep interest rates low. Forward guidance is one, QE is another, and what they found during the summer is that when they said they were going to do less QE, interest rates went up. So they found that they have to reverse that in order to keep interest rates down. And then in the guidance you've received after the meeting, I think what they've done is turn from kind of a retrospective evaluation of we're going to stop doing QE when the economy reaches some level of escape velocity to targeting something in the future where they're trying to get the economy on an even higher growth trajectory. And so what that tells me is from a first principle standpoint where they want to keep interest rates zero, cap interest rates, and get higher nominal GDP, they couldn't quite announce that, but that's the essence of the September decision. They wanted to keep rates low and then get a bigger growth spurt. And they're kind of flailing around right now trying to figure out exactly what instruments will do that, which is why they've had trouble with the messaging. So they're trying to enforce their rates commitment by saying we're not going to do QE. But the problem with the QE, it's a corollary of what Brian and Spencer were saying. At this point, it's not clear that QE is doing anything. I have, the idea in mind when an economy is doing reasonably well, if I take $1 in my pocket and exchange it for $1 in your pocket in the front row, which is essentially what you're doing with some of these purchases, it's not really going to change people's expectations about where the economy is going. So I think the QE angle is getting much more difficult to understand whether it's having real effects.
So let's go ahead.
I mean, I think it's hard to make that argument. I mean, at a time when the mere prospect of slowing down the pace of purchases resulted in such a sharp backup in long-term interest rates, and to argue that's having no effect on the economy would require many dimensions of the transmission mechanism be shut down, which I don't think is the case. So I agree with you. I think a lot of the story was that interest rates moved up more than they had expected, and that was worrisome to them, and they wanted to push back against it. But I don't think you have to go as far as saying they're trying to hit some different objective function or what have you. They were just trying to to be more accommodative in general through the communications about the funds rate. And on QE, I think this was literally just a short delay. They see some near-term risk events related to fiscal policy. They wanted to see how the economy is weathering the backup in rates. So all that led them to just postpone, probably was just going to be several meetings.
Maybe it's a very myopic view, but we do sit in markets, and markets tend to be myopic quite frequently, and we look at instantaneous reactions. But when I look at Wednesday 2 weeks ago, when the Fed made the announcement of no taper, which surprised a very large portion of the market, the instantaneous market reaction was about 1.5% in a $20 trillion equity market. It was about 15 basis points in the 10-year yield lower, and it was about 40 basis points in the back-month Eurodollar futures, or the forward expectations of rates. You had a massive capital gain in equities, a massive capital gain in bonds, huge transmission of policy stimulus immediately into the economy through an unexpected move in QE. So to me, this idea of pushing on a string, and we hear it a lot, we heard it some today even, seems very hard to sell when you see just the mere announcement that we're going to get an extra 3 months of this stuff have such an extraordinary reaction in an unexpected way. So again, before I turn it over to your views on forward guidance as well, Jason, how do you reconcile that?
I don't think we have a good story right now. I think the story has to rely something about the signaling and the reaction function of the central bank as opposed to the literal asset purchases, because I think expectations about the ultimate size of the balance sheet were probably little changed, even marking it from earlier in the year, let alone with respect to what Brian just described. Brian is one of the most knowledgeable people about the Federal Reserve System, and you just heard from him that this was a short delay to the tune of changing the ultimate size of the balance sheet by a couple tens of billions of dollars, maybe $100 billion, maybe a little bit more. But if I told you, if I were to announce today that the Fed's going to buy an extra $100 billion worth of treasuries, you wouldn't think that it would have such a large impact on the market. So I think what the market was doing is trying to do a recursion from the action back into figuring out what the Fed's reaction function is. And I think what they learned in September, in the September meeting that Dave's mentioning the Wednesday, is that the Fed is just much more dovish than they had thought before. This is a Fed that, when it saw the increase in real interest rates over the summer, got scared and wanted to move back and, in some sense, cap those interest rates in order to try and promote a more growth-friendly environment. And that's a reaction function that was different from what people learned starting in May, which was that the Fed essentially was willing to get out of the kind of QE and super accommodation business. So I think there was a direction with that kind of thrust, punctuated by the June meeting, where Bernanke actually gave a full, not official, but full roadmap for how QE was going to turn out, and then he just did the reverse of it. So you learned something about their dovish reaction function, which is why you ended up with the positive asset market response.
Fair enough. Laurence, on the whole discussion of forward guidance versus QE, maybe the ECB perspective, or also certainly chime in on the Fed as well. How do you see that trade-off evolving, and how do you see the limits to balance sheet expansion, in particular in Europe, where I think a lot of people are thinking now, with the German election out of the way, we might be seeing a green light for something out of Mario Draghi, whether it's a funding for lending scheme or an SME lending scheme or something to Southern Europe. How do you see the balance sheet evolution in Europe and the trade-off between using forward guidance, which didn't seem to work as well as maybe planned at the ECB level, versus maybe something more brute force with the balance sheet?
First, I think it was really interesting to hear about the Fed stepping up and then stepping back, because one curve on which it had the most efficient impact was the Ionia curve, right? The ECB announced forward guidance just a week after we started to see the Ionia curve coming off and drifting away because of the expectation that the Fed was going to taper. And then we saw no bigger impact. I mean, ECB's forward guidance had no bigger impact than the Fed actually refraining from tapering. And then we saw the Ionia curve flattening. That was very impressive. So I'm sure the ECB likes the Fed at the moment. It saves it a lot of energy and imagination. In terms of forward guidance, I think you talked a lot about the change in the reaction function. And to me, one big difference with the BOE and the Fed is that the ECB is not changing its reaction function. You had no numerical target. You have no willingness of changing the reaction function. You didn't have anything like the Fed, like inflation can go up by 0.5 point beyond our target. The ECB, no way. This is the target. 2% is the target. Very asymmetric as well. I'm not sure the Fed feels really comfortable with 1.4. The ECB seems to feel comfortable with nearly 1% of inflation. So the ECB was really clear that this is a change of strategy, of communication, and not strategy. And I think what was really weird for the market is that the meeting they explained forward guidance, when answering question, Mario Draghi actually repeated the introductory statement, so it didn't sound more transparent or more clear at all. And when you look at the latest reaction to the ECB's press conference, it had merely no impact on the curve and on rates. And you could see 3 reasons for that. The first one is people get anxious about liquidity in Europe, which goes back to your last question. The second is Mario Draghi was very dovish, and the market doesn't want to hear dovishness a bit unlike what's happening in the US. And they're also forcing Mario Draghi to act. If you're so dovish, why aren't you doing something more? And the third thing I think is this is a very different forward guidance from what you heard from the US or from the BOE, and people feel they cannot grasp it, right? What do you mean? What's your inflation target? 1 is okay, but then 2 is very far away. Do you want to see rates much lower, but you're happy with the spread between Spain and Italy on the one hand, and France and Germany on the other hand? And when you look at QE was designed to put the yield curve down. So how can you differentiate yield curves across 17 European countries? So I think it's very confusing altogether. And talking about liquidity, first, as most of you know, the ECB still has the largest balance sheet of all the central banks, in spite of not doing QE. Second, I think the big difference between the ECB and the US, maybe not so much with the BOE, is the ECB doesn't know what's on banks' balance sheet. And you cannot say that you're going to buy something you don't even know the color of. And that the ECB will only know what's on banks' balance sheet once it has gone through the asset quality review, and that won't be before the first quarter of 2014. So expecting the ECB to buy something they've never seen is just wishful thinking, but it cannot happen. The ECB can do another LTR, it can do a lot of things, but buying now, I don't think so.
And any sort of funding for lending type structures like we've seen from the Bank of England, are those now open and on the table as forward guidance seems to, at least according to the way I read you, backfired somewhat or not worked as maybe everyone would have hoped? Does that put more reliance back to some sort of balance sheet
I wouldn't have dared said it backfired. Funding for lending assumes that you lack liquidity for lending, and that it's a liquidity issue. It assumes that there is demand for lending as well outside. What the ECB has been saying all the time is first, it's a solvency issue. They don't know the quality of banks' balance sheet, and given the existing regulation, putting more risk on your balance sheet as a bank by lending to a small firm is a no-brainer today. So it's solvency. There's very little demand out there, and it's not really a cash issue or a supply issue. So seeing a funding for lending scheme now, before banks have their leverage and before there is appetite for loans, seems difficult to consider.
And yeah, please.
So just a bit around forward guidance and QE. So the premise of your question, David, was how do we think about this trade-off between forward guidance and quantitative easing? I'm not quite sure. Well, I am sure that's not how we think about it at the Bank of England. I'm not quite sure in general that's how you should think about it. So in terms of forward guidance, as you know, the Monetary Policy Committee announced its forward guidance in August of this year. And the essence of that, and this relates a little bit to Laurence's point, was to explain our reaction function. And we have very explicitly said it is not in any way to change our reaction function. We are not in any way changing our reaction function. So please don't think we're trying to get an extra kick from the yield curve by saying we've changed our reaction function. Very clearly, we want to be more clear about the nature of our reaction function. And that was in response to a number of different factors which we were trying to address. I mean, and one was, as our economy now in the UK appears to be growing, the natural, if one looked at the past, if you look at past history, as soon as our economy in the UK had been growing 2 or 3 quarters of strong growth, in the past interest rates had risen. And we wanted to say to people, no, that is not likely to happen this time. We have a big levels problem. The level of GDP in this country is still 3% below its pre-crisis level. In the US, it's 5% above its pre-crisis level. We have 1 million more people unemployed today than there was at the beginning of the crisis. We need to get that levels problem adjusted, and we need to do that by keeping interest rates low for a sustained period. That was one question we wanted to address. But also there was a couple of other issues which we wanted to address, related a bit to some of the points that Jason was saying. The UK, unlike any other, I think is unique in advanced countries in the sense that at the moment inflation is above where we want it to be and output is below where we want it to be. And then when you're faced with that, you have a trade-off where you have to say, how quickly am I willing to bring inflation back down to target relative to how much support am I willing to provide to the real economy? We needed to help people better understand our view of that trade-off, and the forward guidance helped us do that. And the third factor was we also have a remarkable weakness in productivity in our economy during the financial crisis. The level of productivity has fallen in recent years, and relative to sort of simple extrapolation of where you might have expected it to be if it continues to grow in line with its pre-crisis trend, it's well over 15% below where you would expect it to be. And we wanted to explain to people how we were approaching monetary policy in a world where we were very uncertain about what would happen to that productivity puzzle and how much it would come back as demand increased and how much do we think was structural. And the nature of our unemployment threshold together with our inflation, not so-called knockouts, was a way to help people understand that. So that's the reason why we did forward guidance. We were very explicit on the table that alongside that, quantitative easing remained firmly on the table. If we felt that it would take us too long, an unacceptably long time to achieve that unemployment, getting unemployment down to a threshold of 7%, then quantitative easing stood as a natural mechanism by which we'd stimulate the economy more. So they're not complements at all. One is explaining our reaction function, and you can only do that once. You can't go out and say, well, we need to do some more stimulus, let's explain our reaction function again. It's a one-off, it's not a scalable tool. QE is a scalable tool which you can then use to introduce more stimulus. So I think the two things are complements which sit alongside each other.
But you can give the market guidance on how large an output gap you see, and you have done that, and the market doesn't seem to be as accepting of that output gap analysis potentially as maybe the staff at the Bank of England are. And I guess I would ask you, based on what you just said, which was very interesting to me, that there seems to be a lot of confidence that there is a large output gap, just like I think we've had a lot of confidence in the US that there's a large output gap. And a lot of work has been done in the past to show that measures of these output gaps, particularly in the 70s, were one of the things that got us into trouble as central bankers and created a huge problem both in the UK and the US and actually throughout most of Europe. How confident are you as a central banker in our ability to measure an output gap effectively?
Not at all, which is exactly why we designed our forward guidance like we designed our forward guidance. So I'm pretty confident that we have a degree of an output gap at the moment, and I would look at the level of unemployment. The level of unemployment today is 7.7%. Prior to the financial crisis, it was a little above 5%. And there's no strong evidence at all to suggest that we've had some sort of increase in the level of structural unemployment. So I think we need to grow our economy. What the committee was very explicit about, though, is what we don't know is how much of that productivity that we seem to have lost will come back. And that's why we designed the structure of our forward guidance like we have done. So if, as the economy grows, and if it continues to grow at this rate, if we see productivity come back relatively quickly, relatively strongly, in that world, that increased output will be met by increased productivity, and as a result of which unemployment will fall relatively slowly. In the second world, if much of that productivity doesn't come back, as output grows, then people will need to employ more people to meet that increasing output. Unemployment will grow, will come down relatively fast. What the MPC has said is, we don't know how quickly productivity, the extent to which productivity will come back. And so we're relatively uncertain about how long interest rates will be kept low. But what we have said is, and in some sense, it is, for that reason, I don't know how big the sort of implicitly effective output gap is. I don't know how much productivity has come back. But by feeding off of unemployment, I can remain agnostic to that, and I can learn together with the markets at the same time. I guess your point is, in August, we said our best guess is it is as likely as not for us to hit the 7% threshold by the end of our forecast period, about 3 years out, the end of 2016. Yes. At the moment, the financial markets seem to be pricing in a first rise in bank rate before that. My view is if the financial markets are pricing in a sharp rise because they think, well, in the past, every time interest rates, the economy's growing quickly, the banks raised interest rates, I think they should think again, because our forward guidance says clearly that's not the case. If they are pricing in a quick rise because in the past we've been quite synchronized with the US rates, I'd say I'd think again, because the US are about 2 or 3 years ahead of us in terms of their state of the recovery. If they think we're going to raise in 2015 because they think that's when we're going to hit the unemployment threshold, and as soon as we hit 7, we're definitely going to raise, I would say think again, because we've said very clearly this is a threshold, not a trigger. But if they've worked the whole thing out, they have a very strong view about productivity, they also think that when we get it, they're pretty certain that we will raise rates, and they've worked all that out, then that's fine. So as long as they've worked through our reaction function, they take a different view on the economy to us, then that's fine. It's just what we're keen to do is make sure they weren't thinking that we're just going to behave like we have done in the past, because the circumstances in which we're operating now are very different to what they were in the past.
Can I pick up on sorry.
No, just a very quick comment. I guess the ECB has some of the UK element in saying we're using forward guidance to tell the market we will. That's not what you said, but we won't repeat the mistakes of the past. When you think about it, what the ECB is trying to do in a very pragmatic way, say, look, we raised rates in the summer of 2008, that was a mistake. We did it again in 2011, that was a mistake. We're the new ECB, we won't do it again, trust us. I think that's the way forward guidance trying to work a little bit.
So I think the way I think about this is I think the central tension between markets and central banks, especially the central banks that are dominated by the kind of new academic wisdom about how to run monetary policy and a liquidity trapper at the zero lower bound. The central tension is about commitment. And the academics especially will tell you that they're committed to a low rates policy, and they'll describe the various features of that, both in terms of what we should be looking for and in terms of the actual data outturns. I think the markets take a much more what you see is what you get kind of view of things. So they get bored by the commitment. They get tired of the commitment. They want to see further reinforcing of the commitment. And in the absence of that, the market draws the conclusion, I think, from the forward guidance that it's cheap talk. And you especially have a problem if you draw yourself in your mind a 2x2 box of a stronger economy and a weaker economy, and we have forward guidance or we don't have forward guidance. What we know assuredly is that with forward guidance in a weak economy, you can take out all of the risk premium interest rates and promote some growth. What's altogether unclear now, and we're beginning to face at the Bank of England, earlier in the summer at the ECB, and now with the Fed kind of lurching back and forth, is the idea of whether forward guidance can work in that quadrant of that 2x2 box where growth is getting better and you're also trying to keep interest rates low with your commitment. And I think what you've seen is in the reaction to the Carney press conference, in reaction to the lack of an LTRO reinforcing the forward guidance at the ECB, is that if you just give the markets cheap talk and you don't give them something else, they're going to walk away from you. And it may be that it may not be that they strongly disagree with you, but they're going to have trouble moving along with you. And I think what you saw with the September decision at the Fed is, even though it was a small signal in terms of the ultimate size of the balance sheet, the fact that the Fed was willing to go buy more stuff to reinforce the forward commitment was a very important distinction between Draghi saying, we can have low interest rates, but I'm not going to do another LTRO, which might be costly, or I'm just going to explain to you only once, and then cite the 25-page paper on the website about our reaction function, and then not tell anyone else. I think that market is struggling with that issue about the commitment.
But hold on a second, Jason. You said earlier on you were talking about the ineffectiveness of QE, and now we're saying that the balance sheet is the big stick, and the cheap talk is the cheap talk. It really does appear, and I think Brian was kind of intimating this in his comment as well. This balance sheet stuff really works. It works really, really well. And in effect, what the market's saying is, I want you, central bank, I want you, pari passu with me, buying stuff. I want it to be hard for you to exit. I want you to have some losses on your balance sheet. I want you to have a struggle taking those excess reserves out of the system.
And that is the essence of circumventing the cheap talk problem, which is showing that it's going to be costly for you to get out.
Yeah,
but that doesn't have to do. That doesn't have to do whether it's efficacious and me swapping money with private market participants in a very liquid market.
I agree with you, but it is efficacious on the other side.
But before,
is what you're
in terms
saying.
of the signaling, yes.
I mean, before we drag forward guidance through the mud too much, I think. I mean, we should recognize, at least for the Federal Reserve, the Federal Reserve did use forward guidance differently. I think it did use it to convey a shift in its reaction function, a more dovish policy strategy. And this goes all the way back to the calendar guidance and then the switch to the thresholds, but there's evidence that the perceived reaction function of the Fed shifted as this guidance came out. So I think they were successful in changing market expectations about their approach. Over time, they clarified this is about providing accommodation even as the economy recovers. We're going to let this growth go for longer than you thought. And I think there was a lot of success for the Fed, in part because it was using it more aggressively. The thing with the ECB and the Bank of England is they're using forward guidance less aggressively. They're publicly saying, well, this is just an explanation of our reaction function, the one we were already following. It's not a shift in policy. And in the case of the Bank of England, even though they think rate expectations are too close in relative to their own expectations of policy intentions, it's not because the market's misunderstanding the policy reaction function. It's because the Bank of England has a very different view about productivity and how much growth they can have before reducing labor market slack. So the pushback of the Bank of England is on an economic view about productivity growth. The pushback by the Fed was about its reaction function. And you can push back a lot more forcefully and effectively when you're talking about your reaction function because it's something in your control. Whereas when you're talking about a long-run macro forecast, then the market's just going to question whether you're a better forecaster than they are. So
I disagree. I agree entirely with Brian's point here, and I guess to argue against you. We were explaining our reaction function. I was explaining how I was likely to behave. There's no commitment involved in that. I'm not lying. There's no point in me lying. I'm explaining how I'm going to behave. I don't need to put money in here to commit me to behave in a way other than that. I'm just saying, this is how I'm likely to behave. And so this suggestion in the academic literature, and I think in the Fed when they were shifting their reaction function is, well, what's going to keep you there? There's no need for me to commit to anything here, because all I'm saying is, this is my reaction function, and by you understanding my reaction function will help to improve the effectiveness of monetary policy. That's it. And so the suggestion is, forward guidance works or doesn't work, it becomes a moot point if people fully understand our reaction function. So I have a comparative advantage, I think, to the markets in knowing how I will behave. I think it's one thing I'm confident about. I do have a comparative advantage. What I don't think the Bank of England has is some sort of oracle about how fast the economy is going to grow and how quickly productivity will pick up and what will happen to unemployment. So if they fully understand our reaction function, but the markets have a different view to us about that issue, that's fine. We can learn from the markets, and we'll all learn from the economy as the economy evolves. So I think this issue of commitment and working is not quite. I think maybe in the US where you shifted the reaction function, but in the UK when all we were doing is explaining it, I think that sort of those issues aren't as pertinent.
So let me propose the following counterfactual, which is the Fed decision 2 weeks ago went a different way. So there was no change in expectations about QE. So there was a taper of some size. Let's say in the market it was 10 billion. So there was no change in expectations about QE. But the Fed came out in order to underline a more dovish reaction function in their forecasts about 2016's monetary policy, said, we're really promising under our economic forecast, like Spencer was describing, that we're going to have 0 real interest rates even at full employment. My question, I guess it goes back to Brian's point, is to sort out the different mechanisms here in order to highlight this, what I believe is a central tension about commitment. Do you think there would have been as big a response 2 Wednesdays ago if they just showed real interest rates at 0 in 2016, or if it was also supplemented by this extra reinforcement from QE? My conjecture is the market would have had a big yawn about the forward commitment in 2016, and it was the action of surprising the market, even though it's a very, very small amount when it comes to this. Some of these sizes are tiny. Do you think that there would be a 1.5% increase in the stock market in the US if I told you that Treasury was going to cancel an auction or two? Of course not. But that's essentially what the Fed surprised the market with, and yet there was a huge reaction. So I think that the QE underlines the communications tool.
I think the reaction would have been almost as big if they credibly said, we are promising to keep rates at 0 or real rates at 0.
But that assumes the proof, which is if they credibly said, how do they credibly say to a market that has a great deal of skepticism about the forward guidance? And my answer is you have to do something. You have to do an LTRO, which shows that you're doing more. You have to do some surprise on the QE. You have to have some action that reinforces the words.
So, I mean, I understand this view is in the market. But it is somewhat strange that these very near-term decisions about asset purchases that seem to me related to near-term risks are really conveying a whole lot of information about where the funds rate's going to be in 3 years, which is the forward guidance is about 2016 and beyond. So,
Brian,
I think guidance without asset purchases has substantial effects. Now, is it slightly more credible and more effective with the asset purchases? Sure. I mean, why not throw everything at it? But I think you're underestimating how much the promise itself can matter.
I think the promise in Europe and in the UK was shown to be fairly, the effect was pretty limited and pretty...
Had the wrong sign?
Because of the way it was used.
Well, it had the wrong sign as well. Look, we've got a lot of questions, and I definitely want to get you in here. But
it's a repetitive story, right?
Yeah.
I mean, the problem in Europe is that you had the feeling Jason was describing to have been promised things, promised negative deposit rate, lower rate, more purchases, more, a lot of things. Credit easing, not the EIB 10 billion support for lending scheme. So you have this repetitive stuff, which is exactly the credibility that both of Brian and Jason are mentioning. When you think about inflation targeting, at the beginning, who believed that inflation would go down to 2% and remain there credibly for a long period of time? I'm not sure markets were fully convinced by this commitment. And yet, because it was delivered, but it was delivered over a very long period of time, you got it. So you could think that the central banks on this side of the Atlantic are trying to prove their point and their time, that they are not time inconsistent by just sticking to the word over months. But obviously the effect is less sharp and one-off than what's happening in the US.
We have a lot of sayings, talk is cheap, talk softly and carry a big stick, show me the money. I'm sort of the opinion that, there's not a lot of old sayings out there of, hey, what I say is really, that's the driver here. I think markets, and I'm very sympathetic to Jason's view, that markets have a lot of skepticism about the ability of central bankers to remain committed to forward guidance. In particular, in a time where the Federal Reserve, for example, is losing nearly 5 members of its board over the coming year.
So David, just on that, if you're a Martian that came down to
some people say that about me.
And the day before the tapering decision, and you looked at all what the Fed had said, and then looked at the surprise, would you say, God, what should I have done? Should I have listened to what the Fed said, or should I listen to what the markets did? Because the Fed said very clearly, this is not a shoo-in, it depends on the economic data. Right. So perhaps so your moral is, the markets just don't believe what the Fed say. I mean, perhaps the moral of the story is, actually the market should just actually listen to a little bit more what the central bankers actually say, and then respond to that, rather than because if a Martian coming down and had read all the Fed statements, they would be nowhere near as certain as the markets apparently were that the Fed were actually playing some game of double bluff, and it was a complete shoo-in.
So I did listen, and I listened to a greater macroeconomist than certainly I am, who's named Ben Bernanke, and Ben Bernanke said, paraphrasing, but this is basically to your point, it's strange credulity to be talking about our interest rate commitment in 2016. So if you're someone who sits at the head of the most important central bank and is one of the greatest macroeconomists of his generation, who probably could win 2 Nobel Prizes for the body of his work, and he comes out and says it's strange credulity to be talking about interest rate commitments in 2016, what do you think a guy like that is going to alight to as alternatives to maybe supplement that?
But I thought you
something
also
that
said,
doesn't smack of cheap talk.
He also said whether we taper or not is data dependent, didn't he?
Of course.
But your counterfactual, sorry, just to go back to that, was they make a credible commitment to keep real rates at 0 in 2016. That, of course, would have a major market impact. I think your point now is a somewhat separate point. They're never going to make such an absolute commitment. There's always going to be knockouts. There's going to be data dependence and so on. And I think that's important. Right now, I think there's one hard commitment out there, or as hard as it gets, which is the 6.5% unemployment threshold that has to be reached for the Fed before liftoff. Beyond that, they've communicated that after liftoff, they're going to have this very gradual tightening cycle. Their own Fed funds forecasts are very low, 1% at the end of 2015, 2% at the end of 2016. The chairman said it may take 2 or 3 years beyond that to get back to the neutral funds rate of 4%. So he's advertising a tightening cycle that's going to last into early 2019. A very, be the most gradual tightening cycle on record. I think that is purely a forecast. There's no commitment there, and that's the kind of guidance that the market can question, and that I personally question whether it'll be that gradual. But I think the 6.5% threshold is a commitment.
Let me ask you 2 questions to get us moving along. One is on credibility of forecasts of central banks. One of the things we've seen in the U.S. is a complete lack of ability to get their GDP forecast right for the last, long time, but certainly over the last 4 years. And we've seen that forecast of 3% constantly come down. What's behind the constant misses of the forecast? How do we expect how do they expect to gain market credibility with a consistently biased upward forecast? And I'm also struck as I think it was about 2010, so it's been almost 4 years, Jason, since we first did a panel at the Milken Institute on quantitative exiting, which I think was also the title of our panel back then. And what I would say to you is, one is, that's the first question I have, but the second one, and Brian, I'm happy to have you take it off. How does this end? Does this end with too much inflation? Does this end with central banks stuck and central banks allowing a lot of inflation into the system and the monetary base multiplying, as many of those on the committee are worried about? Or is this going to be an easy exit? So I'll throw 2 questions out there for everybody to chew on in the last 11 minutes that we have.
Well, the answer to the second question is I don't think it ends in inflation being unusually high. We may want to turn to that in a moment, because I think that would be a whole extensive discussion on its own. In terms of the GDP forecast, sure, the committee and most of us have underestimated the impact of some of the more persistent drags that were in place, the deleveraging cycle, and so on. And then the other part of the story is we've just been hit by unexpected developments. European stress was greater than many people had anticipated. Now we have U.S. fiscal situation that's a bigger drag than anticipated and poses some near-term risks. So things have happened. What's interesting is the unemployment forecasts haven't been that far off, but I think there's that's kind of 2 things offsetting each other. You missed on GDP, but at the same time you also probably overestimated trend growth in the U.S. So
I think there's a statistic, and Jason will probably correct me if I'm wrong, that if you look at all forecasts of the OMB, the CBO, the Council of Economic Advisors, and the Federal Reserve, not once has any one of those institutions ever forecast a recession 1 year out.
More or less. I mean, I think you'll see eventually that the people at the Fed in 2008 were pretty on the ball about some of the features of the macro cycle turning. But just to go to Brian's point, to bring out the point about the forecast misses, for almost the entire century, short century, the Fed has overpredicted growth, but the unemployment rate forecasts have been pretty good. So to pick up on Brian's point, what does that tell you? If you're getting your unemployment rate forecast right, but your GDP forecast is persistently biased upward, meaning you were too optimistic, that tells you the potential growth is a lot lower than you thought. And this is a committee that just seems to have a less honest discussion than the one that Spencer was describing that the Bank of England is grappling with, because you see in their own forecast they have extraordinarily aspirational views about what potential growth is, what the neutral Fed funds rate is. And I think certainly if you look at the data, if you look at them dispassionately, are telling you the potential growth is certainly at 2% or below that. And that rationalizes a lot of these macro tensions, and would also be a good way to explicate the whole rates path that I think that they probably are hoping to follow, which is one where you have a very gentle hiking cycle up to a much lower neutral Fed funds rate than people are used to. But it's a puzzle why the committee has not been more quick to take on these tensions.
Spencer or Laurence, you want to tackle the question on how this all ends? We have a exiting in our title, so I figured I'd at least have one question, not on should we do more QE or more forward guidance, but maybe what the end game, where are we going with all this? Where are the $10 trillion of securities that have been taken onto central bank balance sheets? Where are they going to end up in 5 to 10 years' time? Where is all this monetary base that we've added to the system? Where's that going to end up? What's the velocity of that base? And will we be able to control it?
So in the UK, we will sell the gilts back. And I have many conversations with various city participants where they smile and say, oh, you won't do that. And the counter example is, well, think about what happens if we didn't. Okay, so we have entered into a contract with the public where we said, we're buying these gilts. We're not buying these gilts and somehow to help out government. We're not somehow doing this to somehow finance the deficit. We're doing this as an emergency measure in order to make sure that we can get our economy back to something like balance and keep inflation close to target. If we fast forward 3, 4, 5 years and bank rate is close to something like normal, but I'm still holding almost 40% of the conventional gilts issued by our government, I think people will ask at that point, how on earth can you justify that? And frankly, we would not be able to justify that at that point. At that point, the only justification would be, well, I'm really worried that if I start selling these gilts, gilt yields would rise. And that's not the job of monetary policy. So, you know, we will, as it's time to start tightening monetary policy, what we have said is we are likely to start raising bank rate first. I think that's a more natural instrument to use first. But once we're in a period where we look like we're going to be tightening monetary policy, we will sell the gilts back. We will do that carefully. We will do that closely in line with the DMO, because it's not in anybody's interest to somehow in any way upset the function of the gilts market. But we need to sell those gilts back for, if nothing else, for in terms of our long-term credibility. We don't need to be holding 40% of government debt, and it's not healthy for the central bank to be holding 40% of government debt. And so we will gradually sell them back as we tighten monetary policy.
To the extent that that has an outsized move on real interest rates, that would be a monetary policy impact, for sure, right?
When you tighten monetary policy, interest rates rise. I can make interest rates rise by raising bank rate, or I can raise, or by selling gilts. But the fact that the gilt yields will rise as we sell gilts is sort of the point as when you're tightening monetary policy.
Well, the ECB is in a very comfortable position, right? It didn't buy. So that's really easy. It took everything and lent the money as collateral, and you can see the balance sheet already declining. It's the first central bank's balance sheet to decline. Might not be the first who should have its balance sheet declining, but that's the fact. But you have, I think, two alternative scenarios. One is the ECB does another LTRO by the end of the year, and if they do that, what they're likely to change is the way they fix the rate. But I think it's quite unlikely that they extend the maturity over a very long period. They would probably just try and get through the balance sheet assessment in a smooth way. And that doesn't change the scenario that when you do this type of lending 1 to 2 years, then naturally after 1 to 2 years, then the balance sheet declines. And we've seen it shrink quite significantly since the beginning of the year. Another scenario would be if they started actually buying things, but then you have to project yourself 6 months after the beginning of 2014, and that would implicitly assume that you're in an economic situation and a financial situation which is markedly deteriorated compared to what it is today. In which case, what would they buy? They would buy loans from banks. And the most likely way that they would do that would be by setting up bad banks in different countries. But why do you set up bad banks? To dispose of assets. So once again, you do something that QE is doing, which is clean banks' balance sheet, but you don't load the ECB balance sheet for a long period of time. So whether you look at LTROs or buying non-sovereign assets, they're in a pretty comfortable position. Buying sovereign asset, I think, is a different word, especially for the ECB, and then you need something really big to push them to do that big time. And politically, you're changing the landscape for the Eurozone, so it's a tail risk. That's probably not what you want to discuss in 4 minutes.
Well, no, listening to Spencer selling gilts, I was very excited about not having any future inflation risks in the UK. That was about as aggressive as I've heard a central banker be, and I certainly don't think I've heard that from any U.S. central banker, and probably won't. So if there's one place where there's a chance for the monetary base to create some problems, it's definitely in the base that you might have had a little hand in creating over the last 3 or 4 years, Brian.
Well, I mean, that's absolutely incorrect. There's no need to sell. Okay, so a couple of observations. The Fed's balance sheet is going to be large, elevated for a long time. I mean, I think it's probably going to be 2020 or so before we get back to a normal balance sheet. So we are in a high liquidity regime for a number of years. Second point is, it doesn't matter. It's not going to create inflation. So the way excessive money creates inflation is if it makes financial conditions too accommodative, if the central bank can't control financial conditions. So it all comes down to, in this high liquidity regime, will the Federal Reserve be able to control financial conditions and tighten financial conditions? And I think the answer is absolutely yes, that it's going to have control over short-term interest rates, and it's going to use short-term interest rates to tighten financial conditions as needed. So it's true that selling gilt or selling treasuries would also tighten financial conditions and could be a second tool used to tighten financial conditions. But I don't think the central bank actually needs two tools, and I think it presents some confusion. It's just easier to use your short-term interest rates as your active policy instrument for tightening. Now, how's it going to control short-term interest rates? Well, in that regard, this new reverse repo facility that it's been discussed in the last two FOMC meetings is very important, I think. So the Federal Reserve, if the balance sheet is probably going to be about $4.5 trillion when the Fed is done purchasing assets. So you're talking probably about $3 trillion in reserves. Now, the Fed can pay interest on reserves, so that's its main instrument for controlling interest rates. The problem is in the US system, there's a lot of leakage out of the banking system. That the Fed can only pay interest on reserves to banks, so non-banks who can't earn that have to go to the market, and the risk is you would have big gaps between the rates available to non-banks and the interest rate on reserves. But by having this reverse repo facility, essentially the Fed is going to stand ready through reverse repos to offer an overnight deposit to all sorts of different institutions. They have 139 counterparties signed up, money funds, GSEs, and so on, and they're going to continue to expand. And so through interest on reserves and this reverse repo facility, they should exercise very effective control of short overnight interest rates and be able to tighten financial conditions. And actually, I think it's important enough. My own view is eventually we'll get to a point where actually they use the reverse repo facility rate as their target variable. I don't really see a great need for them to have a federal funds rate target anymore. In a sense, it's a very conceptually clean framework if the central bank is actually controlling the overnight risk-free interest rate it's offering to banks through interest on reserves and to non-banks through the reverse repo facility. So I think that's a possibility, kind of a longer run question about framework, but I can see them heading that way.
So just to wrap up on one thing, both of you make very eloquent arguments as to how central banks can drain reserves, how central banks can sell assets, how you can get out of this. I guess the one thing it doesn't answer is the political will to do it and the credibility at the time to do it and who's in the institution. We can go back to people like Arthur Burns, who were very esteemed central bankers when they walked into the institution, and by the time they left, they were sort of hanging their head pretty low after Richard Nixon basically beat them to a pulp. So the idea that politics doesn't play a role is to me, the one missing link. All the tools are there. The question is, do you have the political will?
I thought that was why I framed my argument like I did. I mean, it's a counterfactual. How on earth do I justify holding 40% of the government's debt if in 4 or 5 years' time interest rates, bank rates back to normal? I think it's the political economy argument that will be an indefensible thing to do, which means it is perfectly credible for me to say now we will do it, because not doing it will be an indefensible thing to do. And so I think the political economy in this case helps us do the right thing.
Can I end on a point that will be close to Dave's heart, which will be a spoos and blues? Don't worry about that. It's a spoos and blues punctuation mark, which is, I think the risk here is not price inflation for the reasons that Spencer, Brian, and in the ECB case, Laurence as well, we're explaining. You're not really going to end up with a lot of price inflation in this environment is the most likely outcome. I think what you're seeing, though, is, at least in the US, a central bank that is not comfortable with the trade-off they had previously described between financial market stability and very dovish monetary policy. Earlier in the year, you saw the central bank grappling with the idea that there was a reach for yield, perhaps some excesses in certain markets. You saw this notably pushed by Jeremy Stein earlier in the year. And at least the way I would read the September decision is that there was something of a Faustian bargain that we're going to have to live with some potential for excesses in those markets in order to try and achieve our more traditional macroeconomic goals. And I think
John Williams said the same thing.
And I think John Williams was pushing the point about some of the financial stability issues as well, which basically makes it so that you end up in an environment where you end up with low rates and promotion
and bubbles.
well, I wouldn't say bubbles, but you end up certainly with a lot of push into asset markets in a way that perhaps some people will eventually be uncomfortable with.
On that happy note, I want to thank all of our panelists for a stimulating discussion on probably the most complicated issue I see in the markets today, which is where central banks are headed, what they're doing, and how the greatest monetary policy experiment in history will end. Thank you very much, everyone.